Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about PENNYMAC Financial Services INC quarterly report. PENNYMAC Financial Services Inc. offers a wide range of businesses and services through its two main segments, production and servicing. The production segment provides origination of residential mortgage loans, acquisition of government-insured or guaranteed mortgage loans, sale of mortgage loans, correspondent production for conventional and government-insured or guaranteed mortgage loans, consumer direct lending broker direct lending. The servicing segment offers loan servicing for newly originated loans under holding for sale loan administration, services collection and remittance of loan payments, customer inquiry response, accounting for principal and interest, custodial funds management for property taxes and insurance premiums, counseling for delinquent borrowers, foreclosure, and property disposition supervision, loss mitigation activities, including modification and forbearance programs. PENNYMAC Financial Services, Inc.'s stock price has increased by over 26.73% in the past year due to a combination of factors. The company's exceptional third-quarter earnings, surpassing analyst expectations with revenue growth of 10.6% and EPS more than doubling, contributed significantly to this increase. Additionally, positive analyst revisions and price target increases from firms such as Keefe, Bruyette & Woods and Piper Sandler have boosted investor confidence. The strategic partnership with Annaly Capital Management has also helped optimize PENNYMAC's capital and reinforce its recurring revenue model. Favorable macroeconomic commentary, including dovish remarks by Fed Chair Jerome Powell, eased market concerns and boosted investor confidence in sectors sensitive to interest rates. Furthermore, the company's strong performance in servicing and production segments, driven by investments in technology and strategic expansion plans, has also contributed to the stock price increase. Overall, PENNYMAC Financial Services' strong financial performance, favorable market developments, and strategic initiatives have all contributed to its significant stock price growth over the past year. The primary drivers of revenue growth and decline. Revenue growth is primarily driven by several key factors. Net gains on loans held for sale at fair value contribute significantly to revenue growth, accounting for a substantial portion of the company's income. Additionally, loan origination fees, net loan servicing fees, interest income, and fulfillment fees from PENNYMAC Mortgage Investment Trust also play important roles in driving revenue growth. On the other hand, revenue decline is primarily attributed to several factors. The change in fair value of mortgage servicing rights and liabilities has a significant impact on revenue decline. Furthermore, net interest expense income, sales proceeds decrease, servicing fees decrease, and a decrease in effective income tax rates due to California Senate Bill 132 also contribute to the decline in revenue. These primary drivers highlight the importance of understanding the underlying factors that influence revenue growth and decline. By identifying these key drivers, stakeholders can better navigate the company's financial performance and make informed decisions. Net income and profit margins. A shift in performance. The financial summary reveals a significant increase in net income, with a 161% rise from Q3 2024 to Q3 2025, and an impressive 90% growth over the 9 months ended September 30, 2025. This substantial improvement can be attributed to higher stock-based compensation and lower common stock dividends. However, profit margins have shown mixed results. The gross profit margin decreased by 7.1 percentage points in Q3 2025 compared to the same period last year, while it increased slightly over the 9 months ended September 30, 2025. Conversely, net income margins improved significantly, increasing from 16.8% to 28.7% in Q3 2025. The improvement in profit margins is likely due to effective cost control measures and efficient use of resources. Despite the fluctuations in profit margins, the overall financial performance indicates a positive trend, with increased net income and improved profitability. The company's financial performance indicates a strong ability to generate cash from its core operations. With an operating cash flow of $237,269,000, the company is successfully converting profits into liquid assets. This positive trend suggests that the business is financially stable and capable of meeting its obligations. The company's debt level and interest expenses have shown mixed results over the past year. While some periods indicate an increase in interest expenses, such as the 9 months ended September 30, 2025, where total interest expense rose from $279,730 to $328,084. Other periods show a decrease or no significant change. For instance, the quarter ended September 30, 2024, saw a decrease in total interest expense from $4,411 to $4,267. The net interest expense also increased by $9 million and $28.5 million during the quarter and 9 months ended September 30, 2025, respectively. Overall, there is no clear indication of a significant change in debt level or interest expenses. The financial performance of the company's various segments and regions has been mixed. On a positive note, Fannie Mae and Freddie Mac, Ginnie Mae, HUD, servicing and production segments have all performed well. These segments have shown strong results across multiple pages in the summary. In contrast, the corporate and other segment has struggled, with poor performance noted on several occasions. This disparity highlights areas of strength and weakness within the company's operations. Management is optimistic about the company's outlook, citing significant growth in loan production revenues and net income. They attribute this success to their operating capabilities, specialized expertise, and experienced management team. The company is focused on growing its loan production business, with a strong pipeline of interest rate lock commitments and an increase in unpaid principal balance of loans originated and purchased. Management expects liquidity through cash flows from business activities, bank borrowings, and equity/debt offerings. They are actively managing risk by hedging against changes in interest rates using derivative financial instruments and other tools to minimize losses and maximize gains. Overall, the company is well positioned for future growth and profitability. The company has made several strategic acquisitions and divestitures in the financial sector. Key acquisitions include mortgage servicing rights purchase opportunities, forward purchase contracts, MBS put options, interest rate futures purchase contracts, and call options on interest rate futures purchase contracts, derivative financial instruments such as IRLCS, MBS forward sale contracts, and MBS put options. On the other hand, the company has divested conventional loans to PMT in Q4 2025 and jumbo loans to PMT in Q4 2025, loans held for sale, MSRs, and loans with representations and warranties. Principal-only stripped MBS to various banks, including Bank of America, JP Morgan Chase, and Wells Fargo. The company's financial summary reveals that it has engaged in 2 key shareholder return initiatives. Firstly, the company has paid out dividends to its shareholders, as noted on page 75 of the report. This indicates a commitment to distributing profits to investors. Secondly, the company has also undertaken share buybacks, as mentioned on page 95. By repurchasing shares from the market, the company aims to increase shareholder value and reduce the number of outstanding shares. Concerns about inventory buildup are evident in our financial summary. Specifically, there is a noted increase in inventory levels of mortgage loans held for sale, which has led to a decrease in borrowings, page 87. Furthermore, an analysis of the 9 months ended September 30, 2025 reveals rising loan inventory levels, page 88, indicating potential supply chain disruptions and inefficiencies. That concludes the financial summary for PENNYMAC Financial Services INC. Feel free to comment below, and I will be happy to answer them when possible.